Every week, stocks hit new lows for reasons that aren't always obvious. That's why I break down those moves so you understand what's actually driving the market. This week is different. Very few stocks are hitting new lows, while the overall market is pushing to new highs. That tells us something important. These drops are about company-specific problems and narratives breaking down. For example, in the real estate market, Trump's comments about restricting corporate ownership of single-family rentals crushed certain parts of the REIT space. So today, we're going to look at Invitation Homes, a single-family rental REIT, to explore that. We'll also look at Sprouts Farmers Market, a grocery chain hitting new lows that I've long been interested in. By the end of this video, you'll understand why these stocks are losing and what that tells us about where the real stress in the market actually is. Let's start with Invitation Homes. Invitation Homes is the largest single-family rental REIT in the country. Their business is simple. They own houses in major U.S. markets and rent them to people who want a home but either can't afford to buy or don't want to lock in today's mortgage rates. And that demand hasn't gone away. Mortgage rates are still high. Affordability is stretched. And many people who want to own are choosing to rent a house instead while they wait for better conditions. That's the core tailwind behind Invitation Homes. So, why is this stock sitting at 52-week lows? President Trump. Over the last year, rhetoric around rental control and limiting institutional ownership of single-family homes has been building. And now, President Trump's comments about regulating corporate ownership of single-family rentals has investors spooked, even though the underlying business hasn't broken. And that's what makes Invitation Homes interesting. If this regulation risk is overblown, this could be a massive opportunity. The most important number when analyzing a REIT is adjusted funds from operations, or AFFO, basically the rental profits. How fast it's growing and the yield it generates tells you a lot about the business. Right now, Invitation Homes is in a unique situation. The stock is down, so the yield is extremely high, but AFFO is still growing fast. A big part of that growth comes from renewal rates. Tenants renewing their leases pay about 4.5% more on average. The cash flow is very stable too. Occupancy regularly sits above 95%, and tenants stay for an average of 41 months. Their residents aren't just looking for a place to live. They're looking for stability and a home without the long-term commitment of buying. That gives Invitation Homes predictable cash flow. On top of that, the company has a strong balance sheet, with most of its debt at fixed rates. Even better, broader market dynamics are at play. Housing supply is rising, but high mortgage rates keep many potential buyers renting longer. That's the structural tailwind for Invitation Homes. Solid demand for rentals and strong pricing power. Invitation is taking advantage of that, often buying homes from builders at steep discounts. Right now, Invitation Homes is trading at a 52-week low, which makes the dividend yield extremely attractive. On top of that, the company is still growing AFFO, so you're getting both yield and growth in one package. On an AFFO basis, the yield is about 7%. Management is growing AFFO around 10%, but I'm going to be conservative and assume 8% going forward. That gives you roughly 15% total annual return potential before any multiple expansion. To value it, I convert yield into a forward multiple by taking the inverse and adjusting for growth so that it fits into my normal valuation model. If the market re-rates the stock to even a 6% AFFO yield, That results in a massive 135% total return over 5 years. The stock would need to rise 33% before future returns match the S&P. That's what creates a huge opportunity. If regulatory risk is overblown or slow to materialize, the stock could reprice quickly once investors refocus on the underlying fundamentals. Now for risk. Trump's regulation proposal isn't the only reason this stock is at these lows. About 20% of Invitation Homes revenue comes from California, which is both their highest margin market and their biggest regulatory risk. California already caps rent increases, and Invitation Homes has been fined in the past for violations. That means regulatory risk is coming from all angles. The takeaway? This isn't a risk-free setup. You're being paid a high yield precisely because regulation risk is massive. This is a gamble. Let me know in the comments. Are you in? Now, let's look at Sprouts, a stock hitting new lows for the oddest of reasons. Sprouts Farmers Market is one of the fastest growing natural and organic grocery chains in the US. Their mission is simple: help people live and eat better. They do that by curating high-quality products. Organic, gluten-free, non-GMO. You can find it all in a farmer's market-style shopping environment. Right now, Sprouts operates about 464 stores in 24 states. That sounds like a lot, but in the context of the US grocery market, it's just a fraction. That means there's a massive runway for growth if they can continue opening new stores in underserved markets. The company has been executing well over the past few years. Sales have grown at around 10%, driven by new store openings. But investors are nervous about slowing same-store sales and a softening consumer environment. That's why the stock is at 52-week lows. Essentially, you've got a company with real long-term potential that the market is punishing over short-term noise. Let's dig into the numbers, because this is where Sprouts really stands out. First, same-store sales. This is the metric investors are most worried about. Same-store sales still grew about 6%, which is objectively strong, but it came in below expectations. Management blamed a slightly weaker consumer and tough comparisons against prior years, when food inflation was much higher. The concern isn't that growth disappeared. It's whether Sprouts can keep same-store sales growth elevated after such strong prior performance. Now, zoom out. Even with that slowdown, profits are growing faster than revenue at around 15%, driven by expanding margins. On top of that, Sprouts has essentially no debt. That's a strength, but it may also be overly conservative. When a business model is working, modest leverage can accelerate growth and help lock in market share before competition intensifies. They are also rolling out a new loyalty program, which management views as a key lever to reaccelerate same-store sales through better personalization and repeat visits. Bottom line, the financials point to a company that's still growing and improving profitability. Now, let's see how that plays out in the valuation. On a forward earnings basis, the stock is priced as if growth has stopped. The forward PE is about 14.7. Even with revenues slowing, 15% annual earnings growth looks easily achievable. Combine that with an almost 7% earnings yield, and you have roughly 22% growth potential. But I'll use 20% to be conservative. If we plug that into our model, holding the forward PE stable, we get 149% projected return over 5 years. That's huge. But what if the multiple were to expand slightly to account for that growth? Let's say from 14.7 to 18. Now we're looking at 205% projected returns over 5 years. My take? Sprouts is an impressive business, and now it's at a valuation that makes it worth it. This was already on my watch list, but now there's a strong chance I'll buy it. I wrote this earlier, and actually, I did buy it. That's because I don't see many real risks beyond the same-store sales slowdown, and that's the exact issue that crashed the stock and put it onto our radar in the first place. Let's jump straight to the takeaway. This is exactly why we track 52-week low stocks. Even strong, growing businesses can get punished over temporary challenges. That's when patient investors can find real value. Both Invitation Homes and Sprouts Farmers Market show why looking past short-term noise can uncover opportunity. Invitation Homes benefits from operational efficiency and strong pricing power, while Sprouts offers significant growth potential. In both cases, the market is punishing temporary challenges, regulatory fears for Invitation Homes, and a slight slowdown in same-store sales for Sprouts. For patient investors, these are exactly the situations where you can find outsized long-term returns by focusing on fundamentals rather than the headlines. That's it for today, guys. If you found this helpful, hit like. And since you stuck around this long, join me on Discord. Link in the description. I really do want to talk to you. Thanks. Bye.